Now we can pivot a bit into U.S. data points, some economic views that we have going forward, and then just as a quick reminder, please like, share, subscribe. Your support is greatly appreciated. And just as a reminder, we do have our year-end report coming out, so please reach out. It's ready. It's available. Just reach out for samples or the table of contents to see if it's right for you. So here we have just as another good chart of looking at 2001 and 2002 moves and looking at the consumer confidence. So when we look at consumer confidence, because typically consumer confidence is going to be an indication of direction for the stock market. So clearly you can see consumer confidence has come down, but we haven't seen much. And it's interesting to look at the 2002 cycle as we go through, 1990 through 2004, which is that what do you call the gray line and the green line and you can see we're tracking something fairly close to where this looks and how we get some movement. So this is, I think, something to consider. Again, trying to project forward. Again, the consumer confidence can change, especially if we get stimulus, but just think about U.S. stimulus, right? So what is being discussed? So at first, the Democrats wanted 2.3, 2.5, and the Republicans said, no, 1.9. Then it became, okay, well, let's agree for 1.7. And then that fell apart. Then it was, okay, let's agree for 1.3. Now we're down to about 900 billion. And the market has gone up every single time we've had talks on stimulus. And now we're at about 918 billion. And we still don't have stimulus, heading into what is a fearful fact where December 26th is the end of all pandemic support. I should say the pandemic unemployment support, and then January 1st, January 2nd is the end to the moratorium on foreclosures and delinquencies. So again, these are things to consider, which is why I think it's an interesting time as we do look as though we're in a very similar bubble. Now, let's look at the consumer composite versus the S&P 500, just to give an indication of what we're referring to when we look at the consumer confidence versus the S&P 500. Consumer confidence down, market comes down, but quickly bounces back with that stimulus coming through, and consumer confidence has gotten better. But again, lack of jobs, unemployment, furloughs have kept people from being as exuberant as the market would let you, I should say lead you to believe, which is why there's a lot of uncertainty right now as the market continues to push to all-time highs. Now, when we look at the dash to trash, so for those that remember post 2008, the 2009 became, you know how every bubble has terms that you wish would just never come back and would just die a death, just because it's like, why do you have to say it over and over again? And by the end of 2009, dash to trash was burned into my head, and I hated it because it was catchy and it would stick with you and it was annoying. But that's where we are right now. We're at a point now where there's a beta grab. And what does that mean? It means that beta is if a stock trades, the beta, if a stock has a beta of 1, if the market goes up $1, the stock goes up $1. If it has a beta of 2, if the market goes up $1, the stock goes up $2. So typically weaker stocks have a much higher beta. And this is a beta grab where it's people have underperformed. You're getting a move to try to make up performance, and you rush out there and you try to buy as much beta as you can to get to have your alpha essentially outperform the market to try to make up some performance into year end. And that is you can see that we're back to 2009 levels, which is what that was called. So I think it's important to understand or appreciate the strength of the balance sheets that are currently getting purchased as we get quants moving around. Quants were wrong way on things, and now it's a matter of what is real, what is fake, and when does actual stock picking come back into play, or is this something where you're just going to have to ride the beta side? And it's interesting because you might say, okay, well, what about buybacks. So let's look at buybacks. So announced corporate buying, you can see that we're at a low that we haven't been at since essentially 2009, 2010. But at the same time, new offerings. As we've looked at tech, I mean, we've had multiple IPOs that have come out and have immediately gone up 100, 200, 300, 400% with really no end in sight. So you've increased the amount of offerings because people are looking to take advantage of this market. You know, if there's enough money out there, if there's enough liquidity sloshing around because the Fed is just dumping money into the market, the question is, how does it go from the bank to the person? It's through loans, and how many loans are being created. And that's why we're seeing, again, there's just a huge fervor to try to issue your IPOs, because our IPOs right now, our new offerings are at 514. And going back to 2009, we're outpacing by a wide margin, even though corporate buybacks have slowed as people have tried to pull back on their overall spending. And this is why when we look at bankruptcies, again, as we said before, when we look at new reports claiming that 12 million people, 5,800 in background and utilities, bankruptcy petitions dropped substantially this year, driven by the personal filings delays. So here you can see in 2016, in March, we had a big drop down, and it went from 60 to about 40, and now we've gone sideways as people have looked to try to make up being in arrears and trying to close some of the gaps even though as we go into these different things, as it's a frustrating one. But again, this is a positive, seeing these benefits. The question is going to be, as if we don't get an extension as we head into January 2nd for this specific delinquency moratorium. Does this accelerate? Will people look to try to close these gaps? Because there will be that concern as the jobs continue to slow, as we'll talk about in a minute. And as we didn't share it here, but it'll be in our report coming out on Friday, as we go through LinkedIn data, not LinkedIn, Indeed data, and ZipRecruiter, where there's just less jobs getting posted in December, which given it normally does, but it's still above seasonal norms given where we sit in the market. Now, so now let's dig in a little bit. So the small business optimism numbers disappointed to the downside. Expectation was 102.5, came in at 101.4. The other issue is unit labor costs. Again, it was supposed to be down 8.9%. It was only down 6.6%, which is a positive if you think about people, getting something closer to what they were getting on a unit of labor. Mortgage applications down 1.2%. Kind of expected, given it always slows down. We're still running hot, so that's nothing crazy. The wholesale inventories are interesting because expectations were for inventories to grow 0.9% month over month, and they actually grew 1.1%, which is why we keep talking about we are seeing a big recovery in terms of, I shouldn't say big recovery, but we're seeing more inventories get stocked up, which is just going to slow the overall move. But October factory orders were a bit stronger. So this is coming to what you can see here, where they were expected at 1% month over month. They came in at 1% versus an expected 80 basis points. New orders, ex transportation, up 1%. Ex defense up 50 basis points. So again, this is something, but cap goods, non-defense, ex air new orders were up 0.8% versus 1.9%. So again, even though we're still growing, it's at a slower pace, which is still fine. And that's, again, we're seeing those inventories move through. We're seeing factory orders pick up. PMI data, what have we seen? We've seen an increase in new orders. We've seen an increase in export orders. All of these things are good for trying to get some of this momentum behind the economy. The question is going to be how much of that requires additional stimulus. Do we need stimulus if we have this kind of backdrop? Do we maybe need less? Because the market is essentially telling you, look, everything is priced in, everything is going to be fine. or is it, exuberance in general? But anyway, this is where we're always looking. And then when we look at, okay, well, what is the small business optimism index? And you can see that the expectation of the economy to improve declined. Plans to increase employment has actually ticked higher, which again is a positive as we look into next year. But plans to make capital outlays started to slow, which comes to the economy side. Now, these individuals also tend to be a bit more sensitive to government changes. So they typically have a much better view of the world when a Republican is president versus Democrat. So some of this can be factored into that. But again, there's also small businesses, as we've shown with Homebase and as we'll show again, continue to take the brunt of the pain when we look at small businesses versus large corporations. So it's not surprising to see that optimism start to wane. The small benefit is seeing some of that employment start to get a little bit stickier and actually start to increase. The other benefit is small businesses are saying that inventories are too low. So even though we're getting an increase in wholesale inventories, they're saying that there's going to be a continued increase in purchases. Now, again, that's what they're saying. What they actually do will always be different, but they're also trying to push through price increases, which is a little bit of which is support for inventories being low, saying, look, you need, like, my inventories are too low. I'm going to have to raise prices because I'm going to have to rush out and go buy something and pull things through, which is why we're seeing trucking remaining strong. Intermodal remains well bid. And this is what we're starting to see in terms of some of that support. And that's where we're starting to see that some of that pull through into the end of the year. Now, last mile supply chains. These are some of the problems that we're seeing. We're seeing increase in delivery costs, reliable order, lack of warehouses. These are where we're starting to see the e-commerce side of some of this hiring. Delivery carriers are hiring for warehouse and delivery services. These are things that need to be considered when we're looking at some of those price increases. Now, when we look at service PMI, you can see that, again, the employment remains positive. And this is something that is, even though PMI has slowed, it's still in expansionary territory. We're still seeing new orders. We're still seeing an increase in business activity, employment. So again, moving in the right direction. Pace is down, but again, still moving in to help kind of keep some of this growth, hopefully, and kind of spring load us into 2021. And that's why when we look at some of the headwinds now. So now we're seeing number of unemployed 27 weeks and over. These are the people that would be losing a lot of that support from the unemployment, the pandemic unemployment. And this is, here you can see that we have about 4 million people still sitting there on unemployment, 26 weeks and over. And the reason why that's happening, and as we talked about previously, this is an updated chart on, okay, well, what's happening on the 7-day moving average. So here you get Thanksgiving. Thanksgiving's down 83.6%. Labor Day was down 48.2%. Yeah, so there's something. So, there's always going to be a bounce. The problem is the bounce is, as we said it was going to be, is a lower high. And this move down is going to be, again, leads into why is the optimism down? Why are we starting to see some pressure? Why is revenue down? And this is the overhang. Now, the question is, and this is where typically jobs is a lagging indicator, but this is real time. These are people actually going to work, and that's coming down. So if that's coming down, there's going to be less jobs to fill. So, and those people that have been unemployed for a long period of time are going to be concerned about getting a job, aren't going to have the same disposable income. And that's where we start to see those pressures. And that's where we start to see those fears, which is why, even though we get orders going up, some of that is positive. We see some of this, some of these overhangs that are going to keep us fairly muted in terms of how much of that can we actually realize, especially with trade going the way it is. And here's just looking at it a little differently, the share of U.S. population working or looking for work. So ages 16 and up is down, but yeah, ages 25 to 54. Here is where we start to see, the amount of people that are essentially labor force participation continues to be weak, continues to struggle. And here you can see that we had the big pullback because of COVID, a little bit of a pop, but now we're actually losing participation, which again, just showing that there's people who are discouraged. So the unemployment numbers look even worse once you start to factor in those that have essentially left the workforce for the time being. And those discouraged workers continue to rise. This is just looking at it a bit more granular, so it's easier to see. You can see that we had a nice drop, and now we've just been going in the wrong direction to close out the year. Again, this is going to put those overhangs. So when you look at the PMIs, when you look at some of the good data, it was during this period where we had people coming back to work, things starting to normalize. We had people getting hired. Now we're starting to see that discouragement coming through, which again is putting a little bit of an overhang. The global PMIs have come down. They're still expansionary, but global PMIs have fallen, more driven by services as people look to purchase things that they don't use very often, or luxury items much less, and things that they have to, which is more manufacturing based. That remains fairly well supported. So even though the PMIs are in expansionary territory, it's just a matter of what part of the expansion. And then the labor force just continues to not grow, which again, looking at it in terms of just the recession, even though right now the recession will be in question as we've technically recovered in Q3, but again, it's just a matter of understanding. And then this is something that we talked about in the last week, so we won't really rehash. But the total number of unemployed 27 weeks up to that 4 million that we talked about, and they now represent 37% of total unemployed. And this red box are people that would lose their unemployment on December 26th, which is why it's so important. So tomorrow, December 10th, we have the ECB meeting. Then December 11th, we technically have the fiscal cliff because the government will have to shut down. December 26th, we're going to have a loss of these benefits. And then January 1st, we lose, or January 2nd, we lose the moratorium. And this just puts into context in terms of non-farm payroll employment, how we're really slowing down. And again, this speaks to kind of the pace in which we can recover. And as people convert from regular benefits to those benefits, which is only increasing, again, putting pressure on some of these numbers as we go forward. So now that we covered the U.S., obviously there's a lot of data points we can point to. Some days we'll be able to do more, some days less. Just stay tuned. We always try to keep you up to date on things that we think are important, and then try to kind of lean forward on what does it mean going as we look out, not only through the remainder of the quarter, but also into next year. And now in the next segment, we're going to pivot a little bit more into Europe and the euro, and what do we think is going to happen as we come out of the ECB meeting.